Trade management in the sense of position sizing. How much of my account should I be putting into one individual trade? That's what we're going to talk about today. If you've ever taken any sort of class in college, or maybe you've just been searching around online, there's lots of portfolio theory out there in terms of diversification, how much money should you be putting in a single sector or a single stock, all sorts of stuff like that. But at the end of the day, what it's coming down to is just risk management. How are you controlling risk via the amount of money that you're putting into a single stock or a single sector or a mutual fund? Or it's very vast, but what I'm going to talk about is simply trading. That's what this channel is about. That's 95% of what we talk about here. So from a trading perspective, I want to talk about position sizing relative to your account. I get the question quite a bit. Hey, should I be only, I've read that you should never do more than 5% of your account. Hey, I've read, am I putting too much into my account? Sometimes you hear people saying, yeah, I put 100% of my account into a position. And it's like, so the easiest way that I'm going to try to explain this, because that's the hard part about, running kind of a channel, because you have people with very small accounts, you have people with mass accounts, or, just massively big accounts, I should say. So there's no really universal rule. So I'm just trying to create kind of general rules of thumbs and covering just concepts so you can take the broad concept and then narrow it down to your specific situation. And that's what this graph is doing. It's essentially explaining how everything works from a trading perspective. And there's two main functions. Of course, risk is the main one. That's what we're trying to do. That's what the whole position sizing relative to your account is all boiling down to, just risk management. But what it's really determined by is your account size. How big is your account? And the reason for this is that's going to depend on, what sort of risk you have to take. So let's just assign some numerical values to things. Let's say your account is $100. Now, if your entire account is $100, can you do, let's just say, the 5% rule? Well, can you take and then just put $5 into a stock, into Forex, into options? No, you can't do that. Why can't you do that? Well, from a very practical sense, the commissions, the fees, you're going to have to hit a home run just to make even a few dollars profit if you're only doing $5. Again, there's a rule out there, 5% of your account. So if you have $100 and then you stick to that rule, okay, well, that means I can only put $5 into a position. That's just not going to work. So the point here is that the smaller your account size is, if you match that up to where the curve is, you can see that you're going to be taking high risk. You may have to put, I'm not going to say 100% of your account into something, but if you have $100, then, $100 is not enough to even start with. So let's say you have $250. You're at least going to need to put in $100 into a position. Now, from the straight up definition of, portfolio theory and, portfolio management, that's going to sound crazy. That's going to be an absorbent percentage of your total account. But in order to actually make money, you got to throw in decent amounts of money, or else it's not going to add up quick enough, because those, again, commissions and fees are going to get you. So the point here, and kind of the concept here, is the larger account size that you have, the less and less risk you have to take. Let's say you got a $15,000 account. So let's just say, that puts you right here. So you map that up to here, and you map it up. Now you can see that risk has actually gone down from, the person with the, $100 account, $200 account, whatever, because, well, you don't need to put in 30% of your account. You don't need to put in 30, 40, 50% of your account. So your risk is going to be dropping down. Now for, the classic portfolio theory and all that sort of stuff, let's say you have a $100,000 account. So you have a huge account. You map that up here, and you come all the way over here. Well, yeah, your risk is going to be that much lower. And at a $100,000 account, you could do the 5%, because 5%, you could put $5,000 into a stock or an option or Forex or whatever. And $5,000, that's plenty of initial capital, to make some money. What's 1% on 5,000? What's 2%? You start to, look at the percentages, and you can say, all right, yeah, 1%, 2%, 3% on $5,000. Hey, okay, that's profit. You can overcome the fees and commissions. Whereas going back here, at the $100 account, level, and you can only put in 5%. So 5% of that is $5. So then start to ask yourself, well, what's 1% on that? What's 2%? And you're going to see it's just pennies on the dollar. Compared to somebody with a bigger account who's taking less risk, they can still make money. So how much should you be deploying into a stock of your account size? Well, I don't know. That depends on how big your actual account size is and what sort of returns are you looking. Are you looking to make $50 on a trade? If you're looking to make $50 on a trade, that's going to be very hard if you're only using $100 and then only doing 5%. Heck, you could use $100 and put all 100% of that into a single position, and that's still going to be hard to make $50. I mean, you're going to need a 50% return. So the more money you have, the less risk you have to take from a portfolio theory perspective. But I also want you to realize that if you have a small account, I'm not saying don't try trading. I'm just saying don't pigeonhole yourself and saying, well, I read that you can only do 5% or 3% or crazy amounts. Keep in mind that is for big old hedge funds. That is for big portfolio managers that have millions upon millions of dollars. But if you're just an average Joe that wants to get in the market and you got $1,000, well, then you're probably going to be needing to risk more of your account size. Now, regardless though, this assumes that you have a good strategy and a good system in place. If you're just gambling, or if you're just hey, I watched some random YouTube videos, now I'm ready to make money. All right, well, you got a long way to go. But this assumes that you have a good, firm, foundational understanding of the markets, of trading, you have a good strategy in place. Then, yeah, you can start to, risk a little bit more. But to sit there and think that, with a $500 account and then you're only going to, deploy 10% into a certain stock, well, that leaves you with $50. And $50, well, granted, you're not going to lose a whole lot, because if it goes terrible and you lose $50, well, then fine, you've only lost 10%. But in terms of practicality and actually making money, well, it's going to be, ask yourself again, what's 1% on $50? What's 2% on $50? Whereas if you have a $500 account, you may need to put in 50% of it, which would be $250. Now the percentages start to add up a little bit better. Now you may say, oh, you just told somebody to put 50% of your account into a single position. Well, yeah, but that's where it goes to this. The context of the situation. If I'm telling you to put 50% of your account and you have a $10,000 account, that's not so good. I mean, that's literally $5,000. But for a $500 account, 50% is only $250, and there becomes a point where you got to give yourself enough capital into the trade where these percentages here are going to add up enough to not only overcome the commissions and fees, but start to put money in your pocket. So I guess this is kind of a long, broad way of saying it just depends. What sort of position sizing should you take relative to your account size? Well, I don't know. What's your account size? What sort of profits are you looking to make? If you want to make that $50 on a trade or $100 on a trade or $500 on a trade, well, that's going to, you're going to have to determine, well, how much money do I need to put into that trade in order to make it worth my while? And then if that, amount is, 90% of your entire account, your strategy may need a little bit of tweaking. But this is definitely the general philosophy. At the end of the day, the more you save up, the more time you take to save up and to build your account, the less risk you're going to have to take. That's really the moral of the story at the end of the day. But by no means do you need to have millions of dollars to get started. Just understand that the more you have, the better. But also, if you have a smaller account, don't be doing these 2%, 3%, 5% rules, because you're never going to get ahead due to those fees and commissions. So hopefully this makes sense. Any questions or whatever, definitely leave those down in the comment section below. It makes sense in my mind, and it makes sense explain it like this. But if maybe I'm leaving something out, definitely ask in the comment section. I'd be willing to definitely clarify anything that may still be kind of, I'm not quite sure what you mean by that. As always, if you enjoyed the video, click the like button. Check out the channel as a whole. Lots of other videos, live trading videos, chart analysis videos, videos where I talk about mail that I get. So lots of different stuff on the channel, and hopefully you decide to subscribe. But again, keep this in mind. Don't go out there and pigeonhole yourself with some small little amount. But also on the flip side, don't be out there throwing 70% of your account at something when you don't need to, because your account size is already big enough.